Welcome to the Holistic Accountant Podcast. This is where we cut through conventional accounting and show you how a genuinely holistic approach drives better after-tax outcomes. It's not about ticking boxes or churning out tax returns. It's about strategic advice that builds lasting wealth. If you find this episode valuable, leave a rating and share it with someone who will benefit. Okay, today, Mena, I'd like to talk about how to read financial statements like a CFO. Now, I don't think we want you to turn into a chief financial officer, of course, but the fact of the matter is that quite often people think financial statements are just a compliance activity that you do once a year that sort of feed into tax returns, and that's what you pay your accountant for, and they send you a PDF copy and you just file it away and you never look at it. But the reality is that financial statements tell you a lot about a business's profitability. It tells you a lot about a business's health, and particularly, whether they're growing in the right direction and whether there's any growing pains that you might need to consider. And the reality is that CFOs don't really read numbers. It's really about looking for patterns, trends, risks, opportunities, these sorts of things. And that's what Men and I want to talk about today.
So the first point of call financial reports is the profit and loss statement or the P&L statement. Now, this sometimes incorporates the trading statement as well. So the trading statement feeds into your P&L. And what CFOs tend to look at first is the gross profit margin. And that's the real starting point because the CFO doesn't look at revenue first, but they care mostly about the margin. Why? Because margins tell you whether the business is profitable before paying any associated overheads. So it's your first point of call, because if your cost of goods is actually higher than your revenue, then so if you're a service-based business, for example, you'll tend to have a higher margin than, for example, a manufacturing business. The reason being is your labor component is in the bottom section of your P&L, not generally associated in your margin space. Whereas in manufacturing, there's a lot of direct costs, so your gross margins will tend to be a lot lower. So it's really important to understand what industry you're in and understand what margins you should really be trying to obtain and benchmark yourself against those industries. And then you look at overheads as a percentage of revenue. So CFOs don't tend to look at expenses in isolation. They look at trends, as Stuart mentioned before. So things or parameters that they might be looking at are staffing costs rising faster than sales. And if they are, why? Is it sort of the chicken or egg situation? So we need to have more staff on to sort of generate more leads, more revenue? Or is it the fact that we're not efficient? And the next thing they'll look at is marketing spending generating revenue. So what's the direct nexus? Can we link the leads or the clicks that we have, on our Google advertisements, for example, to what leads we're actually getting through the door? Or could it be around subscriptions, software subscriptions bloating, for example? We've got a lot of clients, for example, even in their personal lives, it's very easy to sign up for something, forget about it, and just the direct debits just keep ticking along. Are we actually using this software? Are we getting value out of it? Is there a better solution out there for it? And then finally, you look at net profit, which is obviously the truth behind any business performance. Now, the CFO will tend to look at a net profit as a percentage of an industry average. So we spoke about benchmarking before. Are we on par? Are we doing better? How are we tracking against prior years? How are we tracking against the forecast? And how do we achieve that growth that we're aiming for? This is where owners find out whether the business is actually healthy or is the P&L just busy.
Now, I want to talk about the balance sheet and reading the balance sheet, but I just want to add a couple of comments to what Mena said, particularly in terms of gross margin. Particularly if you're a product style business as opposed to a service style business, it's really easy to underestimate the amount of gross margin that you should be earning, either at a blended level, so, across the whole business, and even on a product by product basis. Sure, you need to make money, and to some extent, there's a lot of businesses out there that are price takers rather than price makers. Although, of course, the whole idea around marketing is to create some more perceived value so that you have a little bit more flexibility around pricing. But you want a healthy gross margin because, of course, you can't control some of the overhead costs. And particularly over the last 5 years through that COVID period, we've seen a lot of inflation. And so it's really important to have a healthy margin, and that margin reflects the risk inherent in the business. And the risk is that if the cost to do business rises, you wear that as the business owner, not your customers necessarily. So I just wanted to add that because I think looking at these profit margins is incredibly valuable and important. Okay, let's talk about the balance sheet and, how can you read a balance sheet like a CFO? Well, I mean, the first thing that I look at is accounts receivable and accounts payable. So, of course, accounts receivable, what you want to do is see that, not that many clients owe you a lot of money. So that is that if there's a certain amount of accounts receivable there that it's very diversified, there's a big large number of clients owing small amount each, rather than one client owing you a huge amount of money. Now, of course, it depends on the nature of your business and how diversified your client base is, of course, but that's what you're sort of aiming for. You also want to make sure that the debt is recoverable, that it's all relatively recent invoices that you've sent out that haven't been paid yet. There's not a lot of, when you look at the age debtors listing, there's not a lot of old debt in there. And you want to make sure that debtors turnover is relatively high. So again, that you don't have, the same names, the same clients turning up in your debtors listing because they're late payers. Again, you've then got to link it back to your gross margins and your net margins to make sure those customers are profitable. And it's like the Pareto principle, the 80-20 rule, that 20% of your customers are probably delivering 80% of your profit. So it's really about finding out who those customers are. And sometimes accounts receivable listing can be a great way of finding which clients you don't necessarily want to take into the next period, or you want to help them find another supplier. Accounts payable. Accounts payable tells you a little bit about your cash flow, really. Hopefully, if you've got a really strong business with strong margins and good cash flow, your accounts payable won't necessarily tell you anything that you don't already know. So there shouldn't be any surprises in there. But you just want to make sure that you are on top of everything. And if we do see a balance sheet with a large amount of accounts payable, we really want to dig into it because sometimes that can be a sign that there's some cash flow issues in the business. The next thing we want to talk about or look at is how much capital is tied up in the business. So that's really what we're looking at is productive assets, so property, plant, and equipment, and any related liabilities. Sometimes what we see, or quite often I should say, what we see in small to medium enterprises is that they're overcapitalized, which means that they have used retained profit to buy very expensive assets. And that's okay. I mean, it's good to have a low level of debt and high cash balances. I mean, there's a huge evidence of particularly businesses in Europe that have withstood, literally centuries of different environments because they've carried low debt. So I'm not trying to talk people out of that, but it's also about what is the most optimal use of capital within your business. And part of that decision-making process is, what's going on in your personal life. So what is the priority? How important is it to build wealth outside of your business from a personal perspective? And that then informs us about, what should the gearing level be within inside the business. So what we want to do is look at return on that capital. So if we've made a recent investment in the business to increase our productive capacity, for instance, has that actually translated into greater profit and cash flow? The last thing I'd look at is working capital. So that's really how much cash is on the balance sheet. And to contradict myself a little bit, we want to make sure that the business can survive a downturn. And the amount of cash that you want to hold as a bit of a safety buffer is going to depend on the type of business, the type of income profile, the number of clients, the industry, all these sorts of things. So there's no real rule of thumb here. But if we've got a business that's undercapitalized, so that is, there's not a lot of cash on the balance sheet, that starts to give us a little bit of concern. And we wonder then, again, is that a consequence of the business isn't just healthy, or maybe the owner's been pulling out too much cash? And that's something we really want to think about. So it's really just pulling apart the balance sheet and really asking ourselves, what does this tell us about the business? It isn't about the numbers per se, but we want to understand the business itself, its key value drivers, the industry, its growths and risk, and then apply that to the balance sheet. And quite often it tells us a story. It's either a good story or a bad story, but also a story around opportunities and what we should be focusing on. So Mena, cash is the lifeblood of the business. So let's talk about cash flow.
as the saying goes, cash is king. So this is where most businesses actually fail. And it's not due to a lack of profit, but a lack of cash flow. Now, you might be profitable on paper, but things such as, high turnaround times or low turnaround times in accounts receivable, but high turnaround times in accounts payable can, for example, put you in a lot of strife. So what CFOs really look at is operating cash flow. Is cash coming in faster than it's going out? So signs of what that might look like is profit, like I mentioned, but there's negative cash flow. So what's happening? Are our debtors not paying us? Do we need to renegotiate our terms? Do we need to renegotiate our terms with suppliers potentially? But there could also be other factors such as growing revenue but shrinking bank account balance. So this ties into basically what we we're talking about, the gross margins before. Now, if you're a price taker, for example, what might end up happening is that you're increasing your revenue, you're getting that volume through the door, but you're actually not profitable on them because you're basically just taking on a price just to get the business through, but your overheads and your margins are costing you, or your COGS are costing you more than what that revenue is bringing in. So by price taking, you're essentially shooting your cash flow. And then what a CFO will then look at is free cash flow. So what cash is left after all operations and investment. So this number really tells you if the business can either grow, pay out dividends to its shareholders, can it expand, or can it survive through tough months? Like in the case that Stuart mentioned before, and you look at the European countries or even some ASX listed companies in Australia, they retain a whole lot of cash and a low level of debt, so that when things such as the pandemic happen or GFC or the like, Trump's tariffs as an example, they can survive through those tough months. And then the last thing that the CFO will typically look at is the cash conversion cycle. So this is how long it takes to turn a dollar spent into a dollar received. So a shorter cycle would mean it's a healthier business, whereas a longer cycle means that it's a cash flow squeeze. So how long is it taking you to get that return on investment essentially?
Okay, so to learn how to read financial statements like a CFO, it's really not about the numbers as in what the actual physical number is, but it's really about what story do the numbers tell us? What are the trends? What are the ratios and the patterns that I can pick up? And if you put that all together, it can tell you a bit of a story. And as we talk about in this podcast all the time, what are the priorities you need to focus on? Because we've previously spoken about, focusing on just a handful of kind of key priorities. I think it starts with having usable, understandable information. So you can build a dashboard in Xero or whatever online accounting system you use that will tell you some of these metrics. You can discuss with your holistic accountants which of those metrics are really important and what are the parameters, where should we see those numbers. That way, because you're in the thick of it every day in terms of running your business, you could look at those numbers, and as soon as they move outside the band, that's a good sort of juncture to reach out and speak to your holistic accountant. But remember, you've got to sometimes outsource to experience. Knowledge is great and it tells us, how to apply this knowledge, like what we talk about in this podcast, but experience is key as well. So sometimes, as a novice, you're not going to see what necessarily your holistic accountant is going to see. So if I was in your shoes, to get greater value out of a compliance service, that is, your accountant putting together your end of financial year reports and tax returns, I'd sit down with them for an hour and really ask them a couple of really probing questions in terms of what does the P&L tell you? What does the balance sheet tell you? What are the three things that, you would focus on if you were in my shoes, and get them to really pull that apart. There might not be any bad news. So we're not looking for bad news. It might be all great news, which means that it gives you the confidence you're on the right track, of course. But it's really, business changes so quickly, and your accountant might be preparing these returns 6 or 9 months after the end of the financial year. You want proactive information and you want proactive advice. And that's why having that dashboard is really important, so that you've got a timely insight to how your business is going. And you've also then got clear parameters of when to reach out to your holistic accountant to have a deeper conversation. Okay, hopefully we haven't turned you into a CFO yet, but hopefully we haven't bored you to death either. But until next week, bye for now.